If you can't use today's inflation rate to set policy and you're not sure what tomorrow's inflation rate is, you're saying the inflation forecast will be secondary to the economic conditions that you think are likely to generate more or less inflation. Is that basically?
Well, first of all, I'm agreeing that it's a very difficult situation in which to forecast inflation, and really very few professional forecasters have gotten it right. So I think we'll look at various things. We'll look at our forecasts. We'll look at the actual data. We'll look at, I gave you the three pieces, yeah, and the elements of those three pieces of core inflation that we're looking at. We will, look at these macroeconomic conditions. Where, for example, we will try to identify a level of a stance of policy that's sufficiently restrictive to bring inflation down. We can't identify that with great precision and confidence, but we'll look at the changes in financial conditions and the effects that those financial condition changes are having on the real economy. We'll look at all of those things and make a judgment, and it'll have to be judgment as to what that is.
Well, when you think you've talked frequently about the need to have policy restrictive, and that often is used as the definition of restrictive is above some neutral rate of interest, the one that will prevail when all is calm. And you gave a speech at Jackson Hole a number of years ago pointing out how identifying all these things, the natural rate of unemployment, the natural rate of interest, the problem is that we don't know what they are. So how will you know when policy is restrictive? How do you think about what the neutral rate is under the current conditions of the economy?
The answer to that is that there isn't any one perfect summary statistic. So the way I think about it, and I think the way we generally think about it, is we make our policy changes and they affect financial conditions. Actually, it works the other way around. Financial conditions tighten in expectation now, different from what it used to be. So they tighten. And so we monitor the tightening of financial conditions. We look at the history of these financial conditions index, and we ask how tight are financial conditions. We also look at the effect that tighter financial conditions are having on the real economy, particularly now interest-sensitive spending, but also other things as conditions tighten. We also look. So, what are the financial conditions we look at? We'll look at the entire rate curve. If you think about risk-free, the Treasury rate curve, we'll look to see significantly positive real rates across the curve. And you have that. You can argue about the short end, but you've got to pick some sort of a forward-looking reading for inflation. And I think inflation compensation in the markets definitely reflects confidence in us bringing down inflation. So you've got real rates really across the whole yield curve. You also look, though, at credit spreads and what are private companies borrowing at, because most borrowing doesn't happen at the federal funds rate. It happens in many other places. We look at asset prices. We look at exchange rates, which are just another asset price. We look at all those things, and we try to make a judgment about whether put some weight on the real interest rate curve, some weight on the other aspects I talked about. I think you have to make a judgment at the end, though, that you're restrictive.
So an estimate of the neutral rate of interest didn't seem to be one of the big factors in that list you gave?
No, it's in there. It's in there in looking at the real rate curve. So you look at the real rate curve, you'd want real rates to be above what we'd estimate as the longer run neutral rate. The issue is, the longer run neutral rate is a rate at a time of full employment and 2% inflation and the economy in perfect equilibrium.